some of the real life market scenarios that have played out, and more importantly, how clients have said those are impacting their portfolios, are worrying them about their portfolios, and then solutions that we are evolving in partnership with our clients. So I'm just going to dive right in, Kate. You talked a lot about diversification, and I can't remember which force it was, and maybe 2 or 1. But with correlations rising, markets becoming more concentrated, how are we really thinking about finding alpha efficiently in our client portfolios?
Yeah, great. And it was 4. It was the actual diversification one.
It was 4.
But yeah. And a couple things I'd say come to mind. Immediately. One, a lot of the work that we've been doing with data and manager selection is helping us be maybe a bit more disciplined about, where is the real skill that the managers that we're hiring coming from? Is it coming from the stock selection, the portfolio construction? And as we kind of refine kind of where we think the managers are adding the most value, we're working closely with Nick and his team to think through what is the best way to really target those pieces of the portfolio versus just taking the full portfolio that we're getting from the manor as constructed. So it's really just trying to isolate the alpha or the skill risk that we think is most valuable, I'd say is point 1. The second one, I would say in some of it, we heard a lot of interesting ideas embedded in so many of the conversations today. There are a lot of specialist managers out there, or certain sectors or strategies that you could drive a lot of value kind of going into like the next 5 or 10 years. But trying to have that fit within your portfolio, knowing that you might have certain broad asset allocation objectives to achieve, can be a bit tricky. So trying to think through how you get kind of those alpha/betas maybe into your portfolio that you're looking for, and maybe using overlays to help just make sure that you haven't gone too far off of your targets, is another one that we've been finding more useful way to just try to open up people's ability to kind of get the best of both worlds. The alpha that they want or the specialized beta that they want, but still make sure that their total portfolio is aligned with what their core objectives are. And the third one is kind of new and old, but the idea of when we think about like U.S. large cap and government bonds not being the best sources of alpha, I think we all kind of know that inherently, but they tend to be big capital allocations within the portfolio. And so we all have heard about kind of portable alpha, for decades almost. But I think there are some new ways that kind of we're getting, talking with clients about like how do you think about implementing it? I think actually Nick will be perfect to kind of dig into that more. But I'd say those are probably the 3 big things.
Yeah, well, certainly, we are hearing more often from clients about portable alpha, existing clients evolving their portfolios. And also the definition of portable alpha is, if I can say it correctly, portable alpha is evolving. So Nick, why don't you take it away on that topic?
Yeah, absolutely. And I think, the definition of portable alpha evolving is, I think, definitely one of the key themes. There's certainly a lot of opportunities once you start thinking about separating your beta allocations and what's required from a capital allocation diversification standpoint for beta and return seeking and alpha opportunities. So I think how investors are thinking about accessing portable alpha or accessing alpha more flexibly, that's certainly evolving. It's not just the traditional structures of the past where you're porting hedge fund alpha or fixed income alpha onto other asset classes, for example. But I think the one thing that is absolutely critical as we're working with our clients thinking about the right way, the right structuring, the right opportunities for alpha transport into some of these betas is really thinking about the funding costs, the alpha hurdles that need to be cleared to capture that real value. Not only just point in time kind of alpha hurdles, but how you're going to be monitoring those levels of funding costs, the risk management, just the process and the whole kind of mechanism around actually putting one of these strategies into place. And maybe just to put some kind of thoughts and numbers, Kate mentioned, U.S. large cap beta being one of those areas where there's often an alpha transport onto that because it's a big asset class. It's generally more efficient, hard to drive true alpha and returns in stock selection or kind of active returns in that space. The funding cost for being long U.S. equity futures, long S&P futures over the last couple of years has gone from under 20 basis points to it's about 50 basis points today. Over some periods in the last 12 months, some of those futures were rolling over 100 basis points expensive. So you need to think about where your real alpha is coming from, how you're transporting that onto the targeted betas, and both sides of it, because you're going to have a short side, you're going to have a long side of that trade, and there's different ways that we're seeing clients actually execute these types of strategies. I'll give you one example, and somebody in the room might recognize this from their own portfolio. We're in the process right now of actually putting a structure in place with one of our large clients. They're thinking, again, beyond traditional portable alpha. They're looking strictly within their global equity portfolio and allocation. And one of the things they're doing strategically is over-allocating to down the cap spectrum. So they're looking at mid-cap and even some small cap strategies, expecting a higher alpha, higher return seeking opportunities from those strategies, but then they need a mechanism to make sure their whole portfolio is cap neutral. So we're working with them on putting the right structure, ongoing kind of hedging structure in place, whereas they're allocating selectively to active mid-cap strategies, we're able to transport that beta risk, that cap risk back onto the large cap space. So there's just, and we're seeing investors think really creatively, and more targeted when they're thinking about alpha and that portable alpha concept.
Awesome. Well, one of the other topics that we talk with clients a lot about, of course, has been the strength in the equity markets. Yep. But more recently, of course, the volatility. I think in March we saw more days with the VIX over 25 than not. So that's making investors get a little bit more focused on what is the downside risk and how should I think about protecting where I am in my portfolio right now. So what are we hearing from clients, and what are we doing?
It's a concern. It's not just equities, though, Lindy. It's across the asset class. I mean, we've been putting on credit default swaps in size recently with some very large clients, multiple clients with historically tight credit spreads, increasing risk. We all saw kind of what's been happening in the private credit space as well. So there's risks in that space. Completion portfolios is another area that we've seen increased utilization across client portfolios. And those strategies are meant to be, not just kind of broad-based hedging or downside protection, but targeting very specific risks in a total portfolio. So, if those that are investing with global or U.S. active managers, you're probably been historically or chronically underweight mega cap tech stocks against your benchmark. So completion portfolios are a way to plug some of that risk, other factors as well in a portfolio. So those are other examples of hedging and kind of risk management tools. But back to the equity space, certainly that's an area where we've been working with certain clients on downside protection strategies. We've been putting on put spreads in a number of client portfolios, just in the last couple of weeks. Even targeted industries. So biotech has had a great run-up. Investors looking into lock some of those gains from those industries. So putting on total return swaps and being very targeted. So I think the theme that we're actually seeing is certainly markets are elevated, risks are heightened. We now have a new geopolitical risk that we need to take back and think about how we're helping clients manage in their portfolio. But helping clients think through their total portfolio and be very targeted in the risks that they're managing has been what we've been doing a lot more recently than if I even think about the last kind of 3-5 years ago when we've had crisis. It's not just a broad-based, hey, we're going to hedge beta, but we're thinking very, very deeply into with clients and their portfolios to be targeted on the risk management.
Well, maybe staying with that same theme, and I'll go back to you, Kate, and we'll switch to pensions. Yeah. So again, with the strength in the markets, pension funded status has improved. We looked at the top 100 pensions. The average is 104% funded. So what are the solutions that we're working on with our pension clients to also help, lock in that status where they are and not have to make additional contributions when they don't want to?
Yeah. I mean, as to think about, for the last 25 years, I've been working with pensions, and it's shifted so much in terms of these poor underfunded pensions for so many years and trying to figure out how to make sure they get the growth but still, hedge. And we're just in such a different environment right now, and it's such a favored environment. Nobody wants to lose that, right? Nobody wants to kind of give up any of the ground there. But there's also this balance of surplus now is getting to be more valuable, whereas maybe 5-10 years ago, even 2 years ago, people were kind of like, oh, it's useless. It doesn't help me. I can't actually access it. And so I think that part of what we're talking to clients about, just as they're thinking around how they're managing their pension and what their strategy is starting to change. Whereas maybe people are really trying to focus on how do I get out of this business and pension risk transfers and just figure out how to, just shrink the pension. It really started to shift in terms of a lot of clients now thinking about, okay, this might actually be an asset for the company. How can I make sure I maintain my funding status and improve like the surplus, but not necessarily like do it in a way that's with outsized risk. And so it's just opening up a whole nother set of discussions that we're having with clients, certainly around once you get more and more well hedged, you need to be more precise about your hedge, right? And so if originally it was like just hedge the duration and do it with leverage so you continue to kind of have the growth in your portfolio, that has shifted so much now, and that you want to be much more, I'd say, precise about your key rate durations. You want to be much more precise or thoughtful about the credit spread, across the curve, both for discounting purposes, but also, for return purposes. And so we're spending a lot more time with clients thinking through how do you more carefully design, that hedge, point one, and that's a lot of the stuff that we're doing with Nick and the team and the pension experts with Russell. And then we're also using it as ways to add in things like the investment grade private credit, right? And so I think it's like we're trying to help clients think about something that used to be just a hedge and just lock down the duration risk and do it as simply as possible and as efficiently as possible. How can we work that capital in a way that is aligned with the newer strategy that people are trying to achieve? And so it's been a really interesting, discussion with clients, but also seeing what some of the leading, other pensions are doing out in the marketplace and how they're trying to think through managing both their corporate kind of plan sponsor risk, but also making sure they're delivering for the beneficiaries. And so I think just trying to be creative with clients about how they can think about advancing their strategy and using different implementation tools to just be more precise on how to execute on it.
All right, well, we're going to shift topics here. We're going to talk taxes, which we don't often talk about in institutional settings, but going back to the beginning of 25, introduction of tax law changes, particularly for private foundations, and, thinking through what we could do to help the clients. The clients were asking us a lot of questions about this, and we happen to have a really strong capability in tax-efficient asset management. And it came from our wealth side of our business. So Nick and team were able to quickly jump in. We've got a lot of good research on this on our website, and of course they've talked to a lot of you in the room about this. But it took a little while for everything to settle out and see where those rates are going to land. But would love to hear maybe a quick summary for everyone on where we are and what we're still hearing and what we're thinking is a great course of action.
Tax management is near and dear to my heart, so if anyone wants to geek out on tax loss harvesting, I will be around later. I've been on a stage like this in front of many advisors talking about tax management, and never thought it would be at our institutional client summit. But if you're affiliated with a private foundation or private college endowment, you had a scare last year for sure when the original proposals for the Big Beautiful Bill came out, and there was some significant tax hikes originally proposed for that legislation. The final bill had modest increases, but there were still some increases for that community. I think what that's done is it's put the topic of tax management back on the radar of a lot of institutional investors. There's a lot of things that you can be thinking about doing in your portfolios today if you're subject to excise tax or potential tax liabilities. Things around accelerating the realization of gains in a lower tax environment before there's a step change, deferring losses, but a lot of the strategies that you would think about coming from the wealth channels, the family offices around tax loss harvesting, taking more control over the realized gains and losses in your portfolio every year are absolutely the playbook that you would need to be thinking about if taxes are a concern today, or certainly for the private endowment and foundation community. We've seen over the last 6 years, I think we've seen multiple changes in legislation. There could certainly be an environment in the not too distant future where those excise tax rates are changing again. So thinking about strategies you may need to future-proof some of your tax management or your tax liabilities. I do want to also point out, it's not just the ENFs that this is a concern for. If you think about the VEBA plans, corporate balance sheets, even captive insurance pools, these are all organizations where having control over the realized gains and losses in the portfolio are really important to the overall organization. So we've been doing a lot of work with institutions across the field in putting implementation and trading strategies in place where you're executing on your overall asset allocation, you're executing even with the managers looking for stock selection and alpha, but we're implementing it in a way where we've got control over the realized gains and losses. That's a huge value to a lot of different types of institutions. It's not just taxes, it's also controlling the realized income, the realized gains, realized losses that flow to the balance sheet of different types of organizations.
Yeah. The only thing I just extend that, the way that we've been doing this for various clients, it's the stocks level stuff that we're doing maybe in the wealth business, but it's also in cases where clients might be holding funds and holding kind of securities as well, really looking holistically at what the best strategy is to help. And that's more of like the smoothing of the gains type of analysis, but it's not just, I'd say, the stock specific stuff that we do extraordinarily well on the wealth side. It's actually looking more broadly at, based on your current assets and how you're implementing, what is the best strategy to manage that. And then with even some clients, we've talked to them about, does it make sense for you to hold the securities directly, or is it better for you to have it in a fund? So even things like that can actually make a big difference, both in terms of how it's executed, but also how you're able to realize kind of the outcome you're trying to achieve.
All right, we've got 2 minutes time. We've got to throw out one quick last question that could go for much longer, but we're going to do it quickly. But one of the forces, I'm not going to guess which one, was the convergence of publics and privates. And as we all know, many large tech companies have stayed private for longer, and maybe there's some mega IPOs coming. We've got clients with a lot of questions about either getting access to them in advance of them becoming a big position in an index or managing the position they have already. So I will turn it over to the experts to comment on that.
You want to? I'll take that one. All right. This is, we heard earlier today, so what, $300 billion of potential flow coming into just the free float, not the overall market cap, the free float of three large IPOs that may potentially, this is going to be an extraordinarily, from my seat, interesting, exercise. There's going to be a lot of capital in motion. And across your own portfolios, you may be on different sides or even both sides of this, where maybe if you've got existing stakes in these companies, how do you think about, once that private asset goes public, you're going to have all sorts of kind of restrictions. How do you access the markets if you're looking to unwind some of those positions, hedging strategies? That's where we've done a lot of work with clients in the past, have a number of playbooks that we're happy to, we do engage and share with. Once there's a liquid options market, hedging strategies become an option. The rate at which you unwind those positions in the public markets can have a huge impact on what your actual exit cost is. And there's a lot of different trading and execution strategies that we work with. But also on the other side, Jason Lenzo was up here earlier. One of the things him and I have been talking about is how do we actually kind of access some of this flow in the IPO market and working with some of the syndicates. So that's a lot of the conversations we've been having, around this time with clients is getting access to that early flow on IPOs, as well as helping clients who have that position map out different roadmaps for themselves on how they're going to hedge that risk, what types of strategies are even available for them, kind of at IPO, post-IPO, when they have a restricted position versus when that position goes unrestricted. But it's really interesting to watch, especially with, as many of us are benchmark aware as well, keep an eye out on what the index providers are doing. This is going to matter a lot. MSCI, FTSE Russell have already started signaling that they're likely to add these positions after a couple of weeks once there's they see liquidity in the market. S&P seems like they're going to hold steady and go through their committee process. That decision is going to drive when passive flow comes in. So you're going to see a rocky couple of weeks. Once passive flow comes in, likely there's some sort of normalization. Who knows what the retail market's going to do and if they're going to be a marginal buyer. So this will be as I said, it'll be a very exciting time. But if you're thinking about your portfolios, there's a number of things that it would be prudent to start thinking about, what's the position that you may need to own even after a couple of weeks in these names, and is it worthwhile to be thinking about opportunities to enter early into the position, or again, if you're one of the beneficiaries of having this name in your private market portfolio, mapping out those roadmaps for a liquidation and other risk management strategies.
All right. Well, we are right on time, Shelley. And we do have research on all these topics up on our website or in other materials within the firm. So ask any of us or any member of your client team if you want to hear more. And Nick and Kate are both here for the rest of the event, so they can answer more questions for you as well on these topics. But thank you all again for having us up here for short, sweet, and a little spicy 20 minutes.
All right.
Thank you.